Uh,
All right.
Make sure I'm probably logged into all my stuff real quick. Yeah, so far looks good. Okay, boom. Make sure I'm logged in. Boom. Make sure I'm logged in. Okay, cool. All right, so let's get started. Um, Real quick, let's start by just kind of walking through FOMC, how it played out, and then kind of how that might set up going into this week. So if we look at FOMC, let's just get rid of this box real quick. Right. If we look at FOMC, which would have been this day right here, right? It was Thursday? Oh no, Wednesday, right here. Sorry. If we look at FOMC, um, there's a very simple pattern for people that want to trade FOMC. We covered it last week for those that remember. And it's pinned on this channel. So if you guys have access to the Discord, you have access to it. If you guys need it, you can either Google it, it'll come up, or you can just reach out and ask. But this is the pattern for FOMC. You get a rate decision. Based off that rate decision, the market then fades that rate decision. Those contracts are already juiced, so you usually don't want to try to chase that. Then during the press conference, you get a lot of back and forth based on all the different things that are said. And then after the press conference, you get the direction, and the direction is usually in line with the first initial move, right? And so if we take a look at FOMC day, we can see that the first initial reaction was to the upside. Then you had a lot of back and forth as you faded and kind of just chopped inside this area ahead of the press conference. And then once everything finished, then we went higher, right? So we followed the FOMC pattern. Now, there were some other interesting things that happened after FOMC. One being that option flow got very, very bullish. So if we take a look at options flow here, we can see that it was extremely bullish, $20 billion to the call side on SPY. So very bullish activity, um, which we want to pay attention to. Also, the dark pool started to get very aggressive. So you can see here that there was a $4.7 billion dark pool print on Friday. So we see increase in options activity, we see increases in dark pool activity. That allows us to start to be a little bit more cautious as we look at key levels and what we're looking for. So what are we looking for this week? So the plan has already been written. I think I still need to add this to T server, which I'll do after the call. But for the bullish side, although we did not hit our weekly target for FOMC week, FOMC week was exactly what we expected. We popped on rate changes, faded the move, and once the press conference was over, we moved in the initial direction. Now we move into what is historically a bearish time of the month with quarterly expirations. So with that, let's get into the plan. The key level to watch here is 663 with end of the month expirations of 930 on Friday. We started holding this level, and if dealers show that they're buying here, I think we can easily springboard up into 670. On the 18th, we saw a $12 million order for 670 calls, which I'll show you guys in a second, expiring on October 3rd. So we know positions are in place. If we break 670, our target is the weekly bullish move of 672.34. On the bearish side, if we reject here, Friday could have looked like a liquidity sweep, which I'll walk through. As we start to retrace back into the downside, it would start with first losing 663. This would kill off buying pressure and push price back down into 660. If we break 660, we lose more buying pressure and the melt up could slow down as we retrace into the 1 hour GP of 655, which is in line with our weekly bearish target of 655.08. If we break the GP, we could slide down into the FOMC low or potentially 650. So what would that look like from a price action standpoint? So if we look at the 4 hour, which is the time frame that we like to look at, we can see that here, these 4 hour candles have been holding 660. Okay. We can also see that on Friday, our 4 hour candle held 663, which is why I said 663 is a pretty important level. Now, the liquidity sweep situation would be that this is your previous high. We then swept those highs. And so if price comes back down below 663, we could see it easily come back down into 660. If we break 660, which we know used to be buyers, you would lose the buying pressure, which would then allow price to come down into this dark pool zone of 657.52 as it retraces into the GP, which is in line with our bearish target to the downside of 655. That is what I was explaining in that write up there, right? In simplest of forms. If price gets below 663, we lose that buying pressure. If we lose that buying pressure, very high likelihood that we can come down into 660. If we lose 660, we lose more buying pressure. Therefore, price could come down into that GP, which would be a retrace on this wave right here, using basically your high here to your FOMC low. And so you can see how this would kind of be that liquidity sweep situation using this as your high and this is your low. Okay. So now the bullish scenario. If price holds above 663, then you have buying pressure coming off of 660 as well as 663. And meaning if you break the high and continue into price discovery, that you would open up your targets to the upside. Now, as I mentioned, if we take a look at whale positions here, we can see that on the 18th, October 3rd, 670, right there. We can see that on the 18th, that a large position came in, probably close to $12 million, of 670 calls that expire next week. We can also see, if we take a look at gamma exposure, and we take a look at SPY, we go to the third, that there is gamma exposure at 670 of 537 million. So again, I'm not saying we're naturally always going to go up, but if we stay above 663, then that buying pressure will stay present. That buying pressure comes from, I think it's next week, or is it this week? So the 660 buying pressure comes from this week, and the 663 buying pressure comes from into the month, right? So you go 930, right? And then there's the 663 buying pressure. So if price stays above 663 and we break the all-time high, we will be looking for price to work its way up. We'll get rid of this fib here real quick. We'll be looking for price to work its way up to first 667. And then if we break 667, up into 670. If we get above 670, then obviously we can go to 672. But those would be the key levels that I'd be paying attention to. So just real quick recap before I hand it over to T. I think you're ready, T, right?
Yeah.
All right, just a quick recap before I hand it over to T, and then we'll get into tickers after T's section. So downside, if price loses 663, we're looking for it to come into 660. If we lose 660, we're looking for it to retrace into 655 into the golden pocket here to the downside. If price stays above 663 and breaks the all-time high, we're looking for price to gravitate up into 667. And if we break 667, up into 670, which is the gamma exposure for October 3rd. So that is what I'm watching for this week. We'll see what happens. With that, I'm going to hand it over to T, walk through some of the other pieces of data that he has.
Okay, yo, yo. All right, let's get started. So I'm gonna do the macro breakdown first, and then I will get into the Costco, JD, UPS valuations and cross asset analysis. So are you guys ready? Okay, so last week, the main focal point was don't overtrade because things can get a bit loopy around OPEX plus FOMC. And the main indicator that I spoke about was the 10-year yield and the dollar index. Both of these are now showing the possibility for a potential change in environment. Okay. But however, I did mention that it's not until we break 4.2 on the yield, right? I specifically said this, before we break 4.2%, something needs to break here where the market will start panicking. So this pullback right now on the 10-year yield is more so of a mean reversion, right? And so when we see the structure of this get broken and this heading higher is when the market will start to then protect and hedge. Okay. The same situation for the dollar index. If you look at both of these, what do they look like? They both look like sweeps of liquidity, right? If you look at the yield, obviously, but if you look at bonds, it's just the opposite scenario, right? It's a breakout and a pullback, right? So then pullback to where, right? It needs to pull back to previous highs. If you realize the previous highs are a little bit further down, so it needs to go further higher. This is also the reason why I'm saying that the 10-year yield needs to go a bit further higher, right? So that bonds can come further down to then get into that area for a further rejection. So right now, the market's not really going to react. If the 10-year yield gets out of control, then it will react. The context of this matters. This is the reason why I'm explaining this. Okay. And the same goes for the dollar. Now, if you're wondering what all of this has to do with stocks and everything else, it has everything to do with it because the dollar is what you use to buy stocks. And then the 10-year yield is where people park their money when they're risk averse or risk on. Okay. So with the dollar, you can see again, kind of a liquidity sweep on a weekly, right? That's pretty powerful, right? And you can see multiple days last week where the dollar started getting stronger. This is after the FOMC as well, right? That's when the dollar is going to bounce back. Okay, so remember, this going higher and this going higher is no bueno for specifically tech. Okay, and at this moment, you may choose to hedge your portfolio. It might be too early, or you may not. It's up to you. Okay, but I'm just giving you the data to tell you what there are possible scenarios with. Okay, now updates. You can see that crypto is kind of nosediving here, right? To come back to previous support. If crypto breaks down, then that's also additional risk off from markets, risk assets, right? The same thing with Bitcoin. Okay, if Bitcoin goes further down, breaks this support, that's going to cause a little bit of panic for risk taking, right? So understand where we're at. Okay, that's something that could happen, and you want to be ready for that if it does happen. China, very nice breakout, very nice sustain of price action, very nice continuations week after week. This is a weekly chart, and the same goes for KWeb, which now has pretty much hit our target, right? At 38.2. Now the next target will be the $48 at the 61.6 extension. So these two markets still doing pretty good. I expect pullbacks, expect some, consolidation and then run high again. We are in a bull market. Do not mistake that. Now, the only thing is how do you protect yourself and how do you make sure that you don't get caught off guard with some weird event, right? Like, for example, the whole $100,000 H-1B visa thing is center headline now. What is the new news cycle that's going to cause that panic? You need to start thinking of that a little bit, okay? All right. So having said that, if the market does pull back, then it has to obviously pull back to previous highs, right? That's where the liquidity will be sitting. So the pullback would be into 64.71. That's the range right here. Okay, all 64.80, just to be very clear cut. And obviously on SPY, that's probably going to line up with Andrew's data, which is at 660, right? That's the pullback area. Okay, 660 or a bit even lower than that. I could go lower to 655 if things get really nasty, right? Now remember here from a technical perspective, SPY is looking like it tried to go for another high and then it got rejected and then it's coming down. It does not mean that it can't come down here and then bounce even higher. Okay, that's not what this is. All I'm saying is understand that the break of structure will be confirmed if SPY breaks below 660 and then rejects 660. This is the break of structure. This then puts in a lower high, lower low, three consecutive times. Okay, then that can open up 655. All right, so from the technical perspective, 660 is really a key level for this week because this causes the break of structure. But you remember that you have that 655 liquidity grab from FOMC. So that's still in play for this week. You have to be aware of that. You could still come to 655 and bounce aggressively back to all-time highs. Okay, this is all very possible. But now the only thing you need to understand is, does this continue a breakout or is this rejecting here? Because the intraday trade could be back down to 660, which is a $3 move. I don't know if y'all want to play that. It's, to my opinion and my facts, I don't think that's a good RR trade base for a day trade, but for a scalp, maybe. I don't know. You need to catch the momentum though. So on NASDAQ, this will obviously be a bit more pronounced. You can see the 38.2 has already been breached. We're now, chugging along to the 61.8 at 25,909. Some crazy stuff has to obviously happen till we get there, right? Like 2 to 3 back-to-back days where stocks are extremely strong, which is very possible, okay? So let's understand that the summary of what I just said is everything is dependent on the US 10-year yield and the dollar. If these two rally strongly this week, right? If these two rally strongly, then that opens up the possibility of rejection, narrative change, people pricing in lesser rate cuts, something or another happening where the market goes into panic. Or not panic, but like a what do you call short fit tantrum, profit taking, accelerant flows to the downside, people trying to capitalize on those accelerant flows to the downside, market maker taking both sides of the action, yada, yada, yada. Now that Friday is over, OPEX from last week, where market makers had positions pinned to the upside, that exposure is now rolled into the next quarter, into the next month, sorry. So you got to be aware that with that comes new data, and we'll be seeing that through what Andrew posts, every other day. Okay, now another thing I wanted to point out was IWM. Have a look at this one, right? On a 6-hour chart or a daily chart, this looks like a potential breakout and then rejection come back in, right? On the weekly, it's not closed. It didn't close above, is what I'm trying to say. It didn't close above the highs. It receded back. And so you got to be aware that this happened. And this might be a potential short entry, right? Now, where does the short entry come from? It does not come randomly here. Okay. You have to, once again, wait for a break of structure. Okay. That means that you're on the 1 hour, you're going to be looking for the breakdown of at least 236, 235 to be really safe, and then a pullback to confirm that this is indeed now fresh supply, and then it can have legs down into 231 or so, okay? And that is a broader trend. This is a swing play, okay? So, but if not, if it doesn't break down this 235 level here, then it has the possibility to come down all the way to here, bounce, and go even higher, okay? So that, remember, this is the break of structure here. It needs to come down here, it needs to reject here, then it needs to go further down, okay? So be aware of that. Next, Adobe. This one should be on your radar. Broken above previous highs. See that? Very beautiful. This was earnings, so it did get up to here. It can also go up to touch this and try to retest this, by the way, right? Uh, Broken above the previous highs and is consolidating above it. Okay, this is another one, a setup that has possible legs up into 375 to 380. Okay, so 365 to 375, 380. There's a $15 upside roughly here, which is decent if you want to play this as a day trade. If the stock is already up pre-market and it breaks this, then forget about it. The trade is not valid anymore. Okay, now how do you hedge against the market, specifically on tech, and then get leverage shares on top of that? That's the answer to that is SQQQ. Disclaimer, this is designed to go to zero. Okay? This ETF is designed, or this fund is designed to go to zero. Remember that. So you cannot hold this for a very long time. This is for pops. Okay? So like you can see in February, right, to April, we had a nice 100% return on this, right? This here, this here, this here. Your aim here is just to buy this for a 1 month period and sit on it and wait for the moment to arrive where SQQQ starts to rally. Because when when QQQ goes down, when QQQ comes down, SQQQ goes up. Okay? So you're just basically playing an inverse ETF. That's what this is. There is a possibility for you to use this. Now, I always recommend stuff like this because you don't have to worry about contracts, expiries, none of that. Okay? It's built into it. It's built into the shares. It's leverage. So you kind of have to understand that you can't hold this forever, but buying a bit of this to hedge against your heavy tech portfolio might be an avenue for you. So let me give you an example of what I've done, right? So as you can see from my portfolio, I've allocated about less than 2%. This is like 1% to this hedge. Okay, 1+%. And I will add more only when I see confirmation. Okay, so remember that don't go and add an all-in position on this right now. Okay, this is something you add in bits and pieces to your portfolio as you get confirmation. Okay, so this is one example of how you hedge using shares. Of course, you can take QQQ put, you can take SPY put. I'm just giving you the tools that you need in case you need to hedge. Okay, not saying that the market's gonna drop. I'm just saying you have the tools if you need them. Next up is Tesla. Beautiful. I think Andrew already went through this. So, okay, now I will do individual tickers another time. I'm going to use the rest of our time to go through JD, UPS, Costco. Okay. So everyone ready for that? Can I start? If you're here and you're ready, can you just say a quick yes so that I know how many people are here listening? Right. Wow, that's very few people. There's like 40 of y'all. Okay, cool. All right, let's get started. Okay. Okay, first we'll go through the important stuff in terms of background on the businesses, kind of like a snapshot. The data from this is been all put together for you guys so that it's easy to understand. I wanted to do them individually first, but let me tell you, there is a beauty of showcasing all three together because JD is a lot like UPS and Costco also has supply chains that are like the other two. So they're very capital intensive. So what do all three of these businesses do? The first one, JD, they're an Asian e-commerce and logistics innovator, expanding globally with a record pace. Okay. UPS, modernizing logistics, undergoing big shifts towards automation and streamlined operations, but staying financially secure. And then Costco, so this is like your summary, right? Costco is a global membership-driven retail powerhouse with strong e-com growth and stable finances. All right, so let's get into it. Let's see first, for the past 1 year, this is the performance. UPS is down 36%, JD is up 22%, and Costco is almost flat, up 5%. Okay, so that's your performance for the year. Let's look at UPS first. So UPS here is a business. Now, they are Upon reading their 10Ks and their 10Qs, which I should probably pull up and give you guys the cliff notes, right? Upon reading, they are in a major shift of basically revamping their entire supply chain. Okay. So this business is in a phase where they have been encroached on by Amazon for a pretty long time. And now what they have done is they have kind of joined forces with them. Okay. So they are very exposed to economic uncertainties, trade policies, labors, all that kind of stuff. Okay. So they will be quite affected during this time, during Trump's presidency, because all of those things are going to be affected, right? For example, when tariffs happen, that's gonna affect UPS to some degree because they do a lot of shipping, right? And so people might order less, they might, you know, do a bunch of things. But anyway, let's look at this. So their main supply chains, okay? Supply chain solutions makes up a small percentage. They have a other sector that's growing pretty big. United States domestic and then international. You can see the split here where revenue comes from. As for regions, Europe's very small, international very small, US very big, right? That's no surprise. Gross profit margin, 18%. 5-year average, 20%. And then if you talk about operating profit margin, that means without taxes, depreciation, amortization, that's 9%. And 5-year average is 11%. So that's not amazing, but they're kind of like just making a little bit of money, right? So the net profit margin becomes 8%. And your return on equity is actually 34%. On a 5-year average, the return on equity is actually 75%. So this passes my return on equity rule. Okay. Return on assets is still positive. Return on assets 5-year is still positive, which are two good things to know as well. So the profitability wise, they are profitable, but it's not amazing. All right. Dividends and buybacks. So they pay a dividend. Okay. 6.55. Dividend payout ratio is 97%. That means they pay out 97% of the time. And dividend yield is actually 7.79%. This is attractive. Okay. So this is also the reason why your EPS is, your return on equity is high, right? So if you look at forward dividend yields, it's going to be about the same. And the next ex-dividend date, you must own the shares by this date. Well, that's already over. So they're going to pay out dividend. Oh, they already paid out dividend too. So there'll be a next one soon. Now, 10-year share buyback ratio. They've only bought back 5% of their shares in the past 10 years. But that's because they are paying with dividends. Okay. So companies can choose different ways to pay shareholders. You need to be aware of this. So for UPS, they're paying back specifically with dividends. And then their share buybacks are like when they do really well. Okay, let's look into the financials under the hood here. I've done the valuation already, but I want to show you what's under the hood here. So revenue, is it consistently increasing? Yeah, I would say so, right? Now it's a bit flat, but it was consistently increasing, right? Net income, kind of flat. Operating income, also kind of flat right now, right? So their performance right now from 2020 all the way to current, the past 5 years, is I. There's nothing spectacular. Net operational cash flow, you can see, is getting affected quite a bit, right? Free cash flow affected quite a bit. Net income was high and then now kind of stabilizing. Stock-based compensation, the pink one, okay, that's not really that important right now, right? And it's also pretty small. Cash and short-term investments are a bit unstable, but the main problem that I have with this business is debt is going up, right? And it's not, I mean, it might be sustainable. Let me just check if it is sustainable because I was looking at it earlier, but then I clicked away. Where is it? Okay, I'll look at it later. It's fine. But the debt is one of the problems here. Okay, now what about their margins? So we spoke about the margins, but let's look at all of them combined, right? So like gross margin, operating margin, and net margin here. So actually, if you look at it, the operating margin is not that bad, okay? And the gross margin is not that bad neither. Obviously, it's flat. But the problem here is the net margin, and that's going down, right? So they need a major restructuring in order for this business to work. The return on equity was nice and then now has become dog shit. Return on invested capital and return on assets are also dog shit right now. So as an investor, when I look at this business, all I'm seeing is this is a business that has a lot of churn. It's churning a lot, but then the output to shareholders is not that great, right? Let's talk about the moat because this is really important. So UPS operates in a highly competitive logistics and package delivery industry with major competitors including FedEx and DHL. UPS is known for extensive global logistics network, reliable service, strong brand reputation. Company competes in factors such as delivery speed, blah, 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 blah. Okay. UPS possesses a narrow moat, primarily driven by its massive economies of scale and high barriers to entry. This integrated global logistics network, brand reputation, okay, blah, 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 blah. Switching costs are moderate, and alternatives exist, and contracts are not especially sticky. So this is a little true network effect, as value does not increase for users as the network grows, right? So it's basically one of the biggest problems here is that Amazon has disrupted this business massively by having massive control of shipping of packages, which then Amazon has invested a lot into its infrastructure for shipping. Now, by the way, UPS and Amazon, they collaborate on shipments these days. Okay. So let's have a look at UPS valuation real quick. So UPS valuation as of today is currently at 144.71. This is based on operating cash flow, total debt, cash, short-term investments. By the way, I've taken a very conservative valuation here. I'm assuming that their cash flows are only going to grow by 5% in the next 5 years, and then meaning 5% per year for the next 5 years, and then 5% perpetually, basically. Because when I was looking at their EPS projection for the next 5 years, it's actually 0 or 1%. And so I'm giving them the benefit of the doubt that they will grow and bounce back just a little bit. Okay. Now, considering this, the stock price has a 72% upside based on today's price. So the actual intrinsic valuation is 144. Okay. This 190 valuation that we did a while back is now 144.71. Okay. So this is going to be 25. Okay. All right. So now, next one, JD. Well, I'm gonna give a summary of all of them later, right? Because I don't think I'm not gonna go and talk to you about UPS right now and then tell you about that. Let's just do all of them and then we'll talk about all at once. Okay, so next one is JD. Now, JD is China-based operation. Now, in terms of their main cash flow generation product, it's JD Retail. Okay. They have JD Logistics, which is growing, by the way. Okay. And then some other smaller businesses. Okay. All in China. Gross profit margin, like you can think of them as kind of like an Amazon, but like more focusing on logistics, basically, right? 15%. Net profit margin, 3%, 2%. You might as well put your money into T-bills at this point, right? Like if your return for the business is 2-3%, you might as well buy treasuries because it's a higher return, right? Return on equity is 17% or so. 5 years, 13%. So that's all right. It's nothing great. They do pay a dividend, small dividend. Dividend yields 2.79%. But I think what is the main story here that everybody likes about this stock is that the stock market, China stock market was so beat down, the economy was so beat down that this is a good turnaround story. Okay. If you look at operating income and net income, they're actually like barely growing here. Okay. But revenues are growing. That's the only thing that the market is fixating on. But if you look at net operating cash flow, you can see the true story here. Okay. So, in my opinion, obviously the year hasn't ended yet. Revenues are very high, but their net operating cash flow is very finicky. Okay. The net income, look at it. One time it's up, one time it's negative, one time it's medium, then it's like this, then it's like this, then it's like this. It goes like that and then like that, right? It's quite volatile. Okay. And free cash flow, look at it. It was here and wham, it's like almost non-existent now in this year, trailing 12 months. TTM means trailing 12 months. So in the past 12 months. So just looking at this already gives me a heart attack as an investor, right? Because like this is very fungible data. Like this is not very interesting to me. Okay, cash and cash equivalents. So how's that? All right, not bad. What about debt? Rising steadily. Okay. Um, they have not bought back their shares at all. In fact, they have taken money from shareholders. Um, dividends, forward dividends. Apparently next year you get 15%. I don't know how that will happen. Okay. Then we look at the profitability. So gross margin, operating margin, net margin. Gross margin, stable. Operating margin, eh, not that stable. And then net margin, negative, and then now here. Once again, not a very nice and stable route, right? ROE, RORC, and ROA, all three now showing uptrends. Okay, great. But does this business have a moat? No, it does not. This is another problem as to why, as an investor, I wouldn't touch this business. For me, this is a deal breaker. No moat, no must. No way I'm putting any money into it, right? So it is one of the biggest e-commerce companies in China, competing primarily. You can read this on your own. Okay, you can pause and read it later on the recording or whatever. Okay, so valuation. Now, there is definitely something wrong with this because I think I've put in the numbers on Yahoo Finance, and I need to instead go and get the RMB values, which is the renminbi values in Chinese currency. So only based on Yahoo Finance, which I'm assuming that these numbers are in US dollar billions, then there is a massive upside for the stock. But I'm going to tell you that I think that the fair valuation is going to be between around $40 to $50. Okay. This is the fair valuation. I will come back to you guys about this valuation because to me, the numbers seem a bit iffy. I don't see how it has such shit everything. And then it's probably because of the huge cash pile that they have. But I will come back to you guys about the valuation. Let's do the last one, Costco. Now you're gonna see there's a reason why I've presented all three of these businesses side by side. Because now let's look at a business like Costco. Okay. You saw two businesses that were kind of shit. Now you're gonna see a business that's actually freaking good, right? I want you to see the stock comparisons between these three businesses and see how they might have similar businesses in certain ways, but then look at the stock comparison and how their revenue is generated, how they're returning money to shareholders. Okay, so business segments. This is where majority of money comes from, non-foods, which is their membership segment. Okay. Warehouse and other business is growing, fresh foods, whatever. How I don't even know what the hell hard lines are. Foods and sundries, that's pretty big part of the business as well, growing massively. Foods and sundries, sorry, sundries. Canada, pretty big piece of the pie. Well, okay, not pretty big, but like it's significant, right? Other international, growing, you can see that. United States, growing. Its business is growing, okay, across the segments. Gross profit margin and net profit margin, very low, okay? But return on equity, very stable and very high. Return on assets, also pretty high. So you might be saying, oh, wait a minute, but then I thought you said this is a good business. Well, you'll see what I mean in a second, right? So have a look at, oh, you know what I should have done was to pull up this in another view. But you can see pays a dividend, okay? Dividend yield is very small, so I wouldn't buy this stock for dividend, right? You're buying this for cash flows, okay? Has not purchased a lot of share buybacks recently in the past 10 years, but revenues growing very strong and significantly higher. And you can't see this pieces of data, but I saw the zoomed in version. But this is also growing higher, okay? Net income from net operating cash flow, higher. You see that? Net income, higher. Free cash flow, higher. Everything is growing upwards. There's no this and then this and then this, right? That's a shit business. This is a stable and cash flow producing business, okay? Now, what about margins? So gross margin, very high, but then operating margin and net margin has been the same or about the same for the past 5 years. However, despite their margins being slim, their ROIC, ROA, and ROE continue to accelerate because this business makes a shit ton of money from memberships that make up for all of this, okay? Now you see the moat. This is what I want to see, a wide moat, right? Costco, and you can read this on your own, but obviously not many people can become a Costco, okay? Nobody can sell, like there are a lot of businesses that have tried this model, set up the same type of model, but they don't do well because Costco had that big first mover advantage. They've conquered this market and now they're expanding overseas, okay? So its bulk sales strategy, efficient supply chain management further enhances its competitive position. It differentiates itself through membership-based model, which fosters customer loyalty and allows it to offer products at lower prices. It has economies of scale, unique membership model, exceptional customer loyalty, and then the Kirkland brand. I'm not sure if you guys are aware, but Kirkland brand is literally the brand that's sitting next to to Kirkland. You guys know this, right? How many of you didn't know this? So if you're going to buy peanuts and you see Kirkland and then you see Skippy, you do know they're the same thing. It's just that they've labeled it Kirkland. It's what they call private labeling, okay? So they're actually the same thing. Okay, now, this is a great business, right? But what about the valuation? So I'm sorry to say to y'all, but Costco's overvalued. So you might think that, oh, it's such a great business, but I want to buy stocks. No, it's overvalued. Okay. So based on everything from Yahoo Finance, a stock currently trading at 951, the valuation is only 544, sorry, 544. Okay. So your Costco valuation is like way down here. So yeah, it's not something you can invest in right now, right? This is double from where it is. So anyway, JD, I'm gonna redo the valuation in using the renminbi values, but I'm gonna give you guys a very high certainty that this stock is between $40 to $50. I will confirm exactly uh, what in a few hours. And that's it. That's your kind of end of this presentation. So now, based on everything that I just presented to you, let me do the summary, right? Is JD investable? Is it a long-term investment? No. Is it tradable for a swing trade? Yes. You see the difference? Okay. UPS. Is this investable long-term? No, maybe. Depending on your risk appetite and whether you have a strong understanding of UPS business and you know someone in UPS who has told you that this business is going to skyrocket. Or tomorrow we see UPS flow, or tomorrow we see UPS insiders buying UPS stock. Then I would say, okay, yes, this is a good potential investment. But is this a good trade? Yes. This is a great position trade, right? A 9 months to 1 year play, you take a lead position, for example, right? Great play. You see the difference? Okay. Now, Costco. Is this investable? No. Is this tradable? Maybe, but we don't know. So Costco's still consolidating in a very big range here, right? So it can keep going ding, 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 ding until something happens. Now, the reason why Costco isn't breaking out and breaking out and breaking out again now is because of the trade wars, right? That's the reason why the market priced in this drop over here. And then since then, it's just been basically trading between this supply and demand. And if you're down here, it's a good chance that you could take a long. And if you're up here, it's a good chance that you could take a short, right? So until it breaks either way, we do not know where this will go. So personally, for me, it's not investable, not tradable. Okay. I hope that summarizes everything and that was helpful for y'all. Let me know if you guys want more of these. I can potentially do it. You want me to do another 3 for next week? Any suggestions? Go ahead. Put in the comment section, and then I'll pick 3. Remember the criteria, guys. Has to be a big cap stock. Okay, it has to be a big cap stock. So if y'all have some recommendations for next week's 3 tickers, can you go ahead and put it into the chat right now? Lulu. Okay, I see Lulu so far. What else? What's ENB? Oh, Enbridge. Oil and gas. Okay. ENB, I'm not going to do because this is not a ticker symbol that many people know, number one. Number two, it's trading almost close to all-time highs. So even if I do a valuation on it, there's no actions. Okay. Oxy, we could do Oxy, but I'll tell you that it's overvalued and it's a dividend payer right now. Like NVO, we could do Walmart, we could do HIMS, we could do. You want to do HIMS? Should we do HIMS? Should we do HIMS? Should we do which one?
Is him still too new? 'Cause I haven't been-
Um, might be. Let me see.
I don't know if it's mature enough.
It's pretty new, yeah. 2020. I mean, you have about 5 years of data now. Not
Must
bad. I mean,
be
you could do
overvalued.
a light DCF, well, like 5 year DCF valuation.
Yeah.
But HIMS is a growth stock, so
I was gonna say it's most likely gonna be overvalued
yeah.
from a valuation standpoint.
What, HIMS?
Yeah.
It's either fair valued or slightly undervalued. Like slightly, very slightly undervalued. Snow, MRK, Snow. Let me have a look at this. Snow's also trading. Oh, okay, Snow. Okay, let's do Snow. Snow's a good one. Okay, let's do
Yeah.
Snow. We'll do Snow. We'll do Walmart?
Do Walmart. I think Walmart might be overvalued.
Yeah. But it's also the background of the business.
Yeah.
Chipotle. Hmm. Oh, by the way, I have an entire summary of the 10K and 10Qs as well. I'll post that somewhere. But this is all just based on my research.
Chipotle might be interesting.
Chipotle. Okay, CMG. Okay, let me end the recording here first of all, and then we can continue talking about this. But yeah. Mm, 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 mm. See you on the next one.
I'm gonna start running through some tickers.